So several months ago, before we saw this big jump in interest rates, I did a video, there's a link down below, talking about controlling risk and how your bank looks at risk. And I talked about loan to cost versus loan to value and things like that. And with today's higher rates, lenders are improving their risk profile and the viability of deals by reducing loan amounts. So for example, if a lender was willing to lend 75% of value on a multifamily acquisition loan before, maybe now they're willing to lend, say, 65%. And this makes sense when you look at it, because since rates have gone up substantially, the smaller loan amount may have a payment similar to the payment for the larger loan amount at lower rates, right? So assuming the same rental numbers, the same income, if the mortgage payments and expenses are still the same, the cash flow from the deal is still going to be similar, right? So the only other way to keep cash flow in an acceptable range would be to lower the amount of the loan by lowering the purchase price of the property. And in most markets, this just hasn't been the case. We haven't seen prices drop because demand is still very high. So higher rates mean that multifamily investors will now, it's become a necessity to put more equity into their deals to make the numbers work. And this means less leverage and lower returns, but it also means less risk for you in your deal, which is why I was recommending this several months ago, even though rates were much lower at that time, because the market was uncertain and it looked like, well, how can I lower my risk? So I talked about that. So with the lower loan amount and a bit more equity in your deal, again, returns are going to be a little bit less, but they're still going to be attractive, and especially compared to the stock market right now. So with rents at all-time highs, and all indications are that they're going higher, these deals to purchase multifamily properties are still in big demand.